No, that is a huge claim, but it's one we are absolutely going to back up. You see, understanding the Fed isn't just some academic exercise. For anyone who's serious about the markets, it's the price of admission. Its decisions literally dictate the flow of money around the entire planet.
So, here's how we're going to break it all down. We'll start with what the Fed is supposed to do, then we'll look at who's actually in charge. After that, we'll get into the real nitty-gritty, the tools they use. From there, we'll explore how the Fed talks to the markets, what data it's obsessed with, and finally, how all of this directly impacts your portfolio.
Let's start at the very beginning. Why does the Fed even exist? Well, its whole purpose is built around a constant, incredibly delicate balancing act.
You know, the Fed didn't just appear out of thin air. It was really forged in the fire of these repeated banking panics that happened in the late 1800s and early 1900s. Its original mission was actually pretty simple: stop the financial system from collapsing. And that role, as the ultimate stabilizer and backstop, well, that's still its core function today.
Now, here's something you absolutely have to understand. Congress basically wrote a conflict right into the Fed's DNA. On one hand, the Fed's got to keep prices stable, aiming for about 2% inflation. But on the other hand, it also has to push for maximum employment. And what's the problem with that? Well, the main tool for fighting inflation is raising interest rates, which, you guessed it, slows down the economy and can really hurt jobs. This constant trade-off is the central drama behind every single decision the Fed makes.
So who are these people making the calls? It's really easy to think of the Fed as just one person in a building in Washington. But the reality is it's a decentralized system, and it's designed that way to pull in a really wide range of economic information.
Think of the system in three main parts. First, you've got the Board of Governors in Washington, D.C. They're the national oversight. Then you have 12 regional Fed banks, everywhere from Boston to San Francisco. And they're like the eyes and ears on the ground, gathering local data. And finally, you've got the Federal Open Market Committee, or the FOMC. That's the group that actually sets monetary policy. So who actually has the power here? It really comes down to this 12-person committee, the FOMC. The 7 governors from Washington, they always get a vote. The president of the New York Fed, because, Wall Street, also gets a permanent vote. Then the last 4 votes rotate every year among the other 11 regional bank presidents. This whole setup is designed to balance that national, D.C. perspective with what's actually happening on the ground across the country.
Okay, so let's get to the tools. How does the Fed turn its decisions into actual real-world impact? Well, it's got a pretty powerful and diverse toolkit to work with.
The first and honestly the most important tool is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. By setting a target for this one rate, the Fed influences the cost of money for everybody. It's the anchor. It's what determines mortgage rates, what companies pay to borrow, and even how stocks are valued. This is the #1 lever of monetary policy.
But what happens when things get really bad? I mean, so bad that cutting the Fed funds rate to zero just isn't enough. That's when the Fed turns to its balance sheet. This chart shows the massive explosion after 2008. It's a process called quantitative easing, or QE. The Fed essentially creates new money to buy government bonds. This pushes down long-term interest rates and pumps cash right into the financial system. And the opposite? That's quantitative tightening, or QT, where they let those bonds expire, which shrinks the balance sheet and pulls money out of the system.
Now, besides those 2 big levers, the Fed has other important tools. Open market operations are what they do every day, buying and selling securities to keep the Fed funds rate right where they want it. Then there's forward guidance. That's just the Fed's way of talking about what they think they'll do in the future to manage what the market expects. The discount window is basically a loan window for banks that are in a tight spot. And in a real crisis, the Fed can even invent new emergency liquidity facilities to stop specific markets from collapsing.
And this brings us to a really crucial point, one that a lot of investors just completely miss. The Fed's power doesn't always come from what it does. It often comes from what it says it's going to do. The market is all about expectations.
See, you've got to understand this. Markets don't just sit around and wait for the Fed meeting. It's a 3-step dance. First, investors build up an expectation based on all the data and what Fed officials have been saying. Second, assets, stocks, bonds, you name it, price in that expectation before the announcement even happens. So the big market move on decision day, that's driven by the surprise, the gap between what everyone expected and what the Fed actually did. If the Fed does exactly what was priced in, sometimes the market barely even budges.
And that right there is why the Fed chair's press conference is basically the Super Bowl of finance. I mean, every single word, every turn of phrase, every tiny shift in tone is dissected for clues about what's coming next.
A single sentence from Jerome Powell can literally reprice trillions of dollars across the globe in a matter of minutes.
So, if what the Fed says is so important, what are they looking at that makes them say it? To have any chance of predicting the Fed, you have to understand its reaction function, basically the data that feeds into its decisions.
The Fed says all the time that it's data-dependent. It watches inflation like a hawk, and it really prefers a measure called personal consumption expenditures, or PCE, because it thinks it's a broader view than the CPI everyone else watches. It obsesses over the labor market, payrolls, unemployment, and here's the key, it also watches financial conditions. If the stock market rallies too much or corporate borrowing gets too easy, that can actually work against the Fed's goal of cooling things down, and that might force them to sound even more aggressive.
So on Wall Street, you'll hear two words thrown around constantly to describe the Fed's mood: hawkish and dovish. A hawkish Fed is worried about inflation, it wants higher rates, and that's usually a risk-off signal for markets. A dovish Fed is more concerned with growth and jobs, it wants lower rates, and that's usually a risk-on signal. Every piece of news is filtered through this lens. Is this hawkish or dovish? All right, let's bring it all home. Let's connect all this theory directly to how markets perform, because Fed policy moves in cycles, and these cycles have really predictable effects on different asset classes.
This right here is the classic playbook. When the Fed is in a hiking cycle, raising rates to fight inflation, bond prices tend to go down, stocks feel the pressure from higher borrowing costs, and the US dollar gets stronger. But when they flip to a cutting cycle to boost the economy, you usually see the opposite. Bonds rally, stocks tend to follow, and the dollar weakens. Knowing what cycle we're in is absolutely fundamental for allocating your capital.
And this brings us to the common traps people fall into. So many people just look at the headline rate decision and ignore everything else. They forget that financial conditions are a huge piece of the puzzle. They just assume that rate cuts are always good for stocks. But hey, if the Fed is cutting because a recession is right around the corner, that's a whole different story, right? The key is to trade the big picture, the narrative, not just the headline.
So, if you want to boil it all down to the institutional view, here it is. The Fed is the master of liquidity. It doesn't directly control the economy, but it controls the financial environment that the economy lives in. It reacts to data and risk, and its number one tool for moving markets is by shaping our expectations. If you get that, you get macro cycle.
And that really leaves us with one final big question. The Fed's toolkit was designed for a world of financial crashes and dips in demand. But what about today? In an era of supply chain chaos, geopolitical wars, and all these new kinds of risks, is just controlling the price of money still enough to keep things stable? That is the massive challenge facing the world's most powerful economic force right now.